Drew, it's good to have you here. Again, we've seen a much more optimistic tone in the market the past couple of days. Is it possible they're gaming this thing out to a better outcome than those who are worried about emptying store shelves and recession are sort of seeing?
Well, so I think there's two things. First of all, yes, you can game out a better outcome because China's not the only game in town, right? I mean, it's the game we're talking about, but there are lots of other large countries. There's a lot of movement potentially among other countries. And if we can see some trade deals done where it becomes obvious that the administration is willing to move towards better trade deals with other countries, that'll actually put kind of a level of confidence back into the marketplace. The real challenge, though, is in the near term is that once you've kind of stressed people out, it takes a long time for them to unstress. And so for people who are invested in equities who saw a lot of volatility in their wealth in the last couple of weeks, those people are probably not going to be really confident to spend any of that wealth that has been accumulating over the years while they wait to see how permanent the actual equity market gains are. And so our concern really is that those upper income workers who have been kind of leading the economy forward are going to begin to retrench. And when they retrench, everyone's going to suffer for it.
Because we often watch for signs of weakness in the lower end consumer and things like that when the economy's cracking. But when we've talked about the white collar recession, and even going back to 2022 and that kind of thing when we had the tech slowdown. But you're saying, if high income people who have a high propensity to spend, if they're the ones pulling back because of their wealth loss and what they perceive to be happening internationally, that itself could slow the rest of the economy.
Exactly. I mean, we had already seen before the tariff situation, lower income workers beginning to pull back, saying that they were more stressed, less likely to be able to make their credit card payments and other debt payments. So we had already seen weakness there, and a lot of that had to do with very low hours worked in the economy. So workers were getting paid more per hour, but they were seeing their hours get reduced, and that was creating stresses among lower income workers. And now we have a stressor for upper income workers. And so the consumer is facing a lot of problems. And then, of course, you have corporate investment, which is really kind of at a very strained point right now, because where do you invest? Where's safe to invest? And what are you investing for? Are you investing because you expect tariffs to be 20%, or you expect tariffs to be 10%, or you expect tariffs to get completely reduced? It's very difficult to figure out where to put your money and what the potential return on that investment is if you're a corporate executive.
So finally, what did you make of the durable goods report this morning? This huge surge in aircraft orders, which is temporary good news, but then what? And how many more reports should we expect like that?
Well, it's a huge surge in orders, but shipments are what they are because it takes a long time for all these things to play out. If you want to take the positive side of the argument, it is that they do not expect the tariffs are going to be long lasting, right? And one of the key metrics I would look at just going forward is, if the market is behaving, let's put it this way, if the dollar is doing okay, then the market likes what they're hearing. If the dollar is weakening, then the market's not liking what they're hearing because everything is so tied up with trade and trade negotiations that really the dollar can be the key signal for people to watch going forward.